folks, today we have a very special guest. His name is Professor Cam Harvey. He's the professor at Duke University. Doc, welcome in.
Thank you for inviting me.
It's a strange financial world. I've been around the financial arena for 33 years. I've watched it before I got into the financial arena. Well, you know, the market goes up, down, all around. People get influenced and enticed, sometimes by big market swings either way. A lot of people sell when they should buy and buy when they sell. But, you know, overall, do you think that headlines influence people's investing habits too much? I mean, get in the way, in other words, of people's success sometimes.
One of the key things is that the stock market is volatile.
Yeah.
And some of that volatility is just what we call noise.
Yeah.
So there's some short-term news, people overreact to it or underreact to it. And that leads to mistakes in the short term when people should be thinking about longer-term investing. It's one of the biggest mistakes that investors make. They look and judge the short-term news to make very consequential decisions for their portfolio. So they should have a longer-term perspective.
You know, I grew up as you did when we had newspapers. That's how we got our stock news. Like you'd look at, you try to find your stocks the next day in the paper and see if you were up or down before the internet. Remember those days?
Yes. Yeah.
Do you think the internet has sped up the market cycles in people's heads? I mean, we used to say if you didn't have 10 years to wait and leave a stock alone, you really shouldn't get into a stock because of the cycles of the market. Your opinion on just overall the rapidity, well, I don't know if that's a name, but people are trading so rapid, they're not really giving time a lot of times for their stocks to grow. Sort of like if you planted a seed, and if a seed didn't sprout in a day, you retill the soil and plant another seed. Do you think patience has suffered because of social media?
Definitely. So, and it's interesting you give the newspaper analogy. So to get a story into a newspaper was vetted. So you've got professional reporters, you've got professional editors, and you've got this lag of 24 hours. So what it does is it reduces some of this noise. Yeah. Now, anybody is a reporter. Anybody is a blogger. There's almost no editorial control. And this is a fundamental difference, the more outrageous your comments, the more eyeballs or page views that you actually get. So there's an incentive to actually say things that are exaggerated, and that influences people. So I think that the internet and the rapidity of the information has made things worse. And I come from the University of Chicago, the School of Efficient Markets, but I'm not afraid to say that the market today is less efficient today than it was 20 years ago.
And the reason being because people aren't educated enough, or what's the main reason why it's not quite as good as it used to be?
Yeah, so people naively measure the efficiency of a market by things like, well, transactions costs, which have come down dramatically.
Yes.
And you've got online brokers that make it very easy to trade. So what this has done, paradoxically, is it's increased the number of retail investors, and those retail investors are operating at a very large disadvantage. They do not have big data and quantitative models working for them. And the second thing that's really important is the explosion of passive investing. So passive investing is more than active investing now. It's about 53% of all investing. And a passive investor doesn't care about fundamentals. It's completely irrelevant. They just buy according to market capitalization. And what that means, it hardwires into a portfolio a mechanical overinvestment in overvalued stocks and underinvestment in undervalued stocks. So this is very negative for price discovery. It's negative for liquidity. It's negative for systemic risk because these giant buys of everything happen, and they can be giant sells of everything. So you put these things together, and markets are not what people thought they would be 20 years ago, and we've kind of degraded.
So the individual investor, I think they're more and more at a disadvantage if they're trying to swing trade or day trade, right? Because you're going against these massive algorithms and AI, computerized trading. You really don't stand a chance. You're being led to slaughter as a sheep a lot of times, aren't you?
Oh, this is definitely the case. There's a reason that the transaction fees are so low on Robinhood. That's because Robinhood sells their order flow. And you think, well, like, who would want to pay for the order flow? Well, it turns out Robinhood, and not just Robinhood, but other online brokers,
right,
mainly retail investors, and the hedge funds actually want to trade against a retail investor. So a hedge fund doesn't want to trade against Jane Street or Citadel.
Right.
So they want to trade against a retail investor. If they are, let's say, buying securities from Citadel, they're thinking, well, what does Citadel know? They might know something that I don't. That's a dangerous trade. But if they're trading against retail investor, no big deal. So they're willing to pay for it. And this is just another layer here.
And it's not just buying; they're shorting into the buying, right, a lot of times. That's what I see a lot of times. Is and dark pools they're called too. A lot of times some very mysterious shorts. We'll say it nicely that you really don't stand a chance if you're trying to beat the big boys in this kind of game. Sort of like going to Vegas with a couple $100 and thinking you're going to beat the big bookies there who know what the spreads are and the games and all that kind of stuff. When did you see a change? I mean, back in the day, because I remember I think my first JB Oxford was my first online trading account back in the late 90s, and it was $300 a trade plus a penny per share, and that's when we had the 12.5 cent kind of levels too. So there's a lot of money was made on each transaction, and now they're making money on making it affordable to get in because they can short when you're buying. They know you're buying, so they can even take your shares sometimes and nakedly short them.
Yeah, and definitely. So. The acceleration really happened about 4 years ago when the amount of online trading really exploded and the price, like the cost of trading, just went down dramatically.
Yeah.
So on your mobile phone, you're checking and trading all the time. So that's when it really took over. The passive investing has been increasing very steadily. So I've actually done calculations and looked at the degree of passive compared to overall investing.
Right.
As I said, it's like 53% now, but it is on trend to go to 80%.
Wow.
And at some point, like what is the threshold where markets become really dysfunctional?
Yeah. Well, and then a lot of these brokerages will let you go on margin. And maybe people were doing home equity lines, and that happened in 2008. And I saw a lot of people getting a lot of trouble for doing that financially, but people are still doing it because it's like an online casino. It's fun to win,
That's right,
and a lot of times you lose, and now you're trying to play catch up, and that's where people are getting in trouble. They're putting their What worries me the most is people are doing this with their retirement money. I mean, that's one thing to do it with money you can afford to lose, but you can't afford to lose the retirement money.
Yeah. So. Again, the online brokers make it so easy to trade. And it's not just stocks.
Yep.
So we've got prediction markets also that are increasingly popular.
Yes.
Where you can gamble on almost anything. You've got crypto on the side.
Yeah.
So this is basically enabling large-scale kind of gambling.
Right.
It used to be that you needed to get on a plane to go to Vegas.
Yeah. You don't need to anymore.
That was expensive to do. Yeah.
Vegas is having less people come out there now, mysteriously.
Yeah, they had to restructure.
Yes.
Yeah.
It is, again, we're with Professor Cam Harvey, folks, a great professor in finance here at Duke University, right down the road from where we're taping this. Crypto, you mentioned that. Your opinion on crypto? I mean, it's come out of nowhere, and, we watch Bitcoin go way up and go way down, has 90% swings. It's not for the light at heart, is it?
No. So Bitcoin is extremely volatile. So think of Bitcoin as 4 times as volatile as the S&P 500.
Wow.
So think of Bitcoin, and it is sometimes sold as a substitute for gold as a safe haven asset. But let's consider the following fact. Over the last 14 years, Bitcoin has had a drawdown of 60%, 60%, 6 times. And that's not including what's happening today. So any asset that's got drawdowns like that so frequently is hardly a safe haven asset. So it is also important to actually differentiate the different types of crypto.
Right.
So Bitcoin is a crypto that originally was going to be a method for peer-to-peer transactions. That was the original model of Satoshi Nakamoto.
Right.
It's not. It's a store of value. It doesn't have much throughput. It's got value because people believe it's got value. There's other cryptos that have like more utility. So Ether, which is the crypto of Ethereum, you can do the transfers from one person to another, but you can also use that currency to pay for computing time on the Ethereum system.
So it actually has a value. It has something of use.
You
right?
pay Amazon Web Services for computing time, so you pay Ethereum. So it's got some tangible value, and these computer programs are very interesting because they enable yet another layer, and that is the collateralized crypto. So think of stable coins.
Okay.
So these are not volatile, or they're only as volatile as the underlying asset.
Yes.
And these stable coins are extremely useful. We now have regulations in the US with the Genius Act, and they really disrupt the banking system. So think of a transfer anywhere in the world in 1 to 12 seconds.
That's amazing.
Compared to 3 to 5 days.
Yeah.
So it really does change the game. So I would say that I'm more enthusiastic about the cryptos that actually have some fundamental value than ones that are just used for speculation.
I was talking to some friends about that same thing because Bitcoin was originally built to be the transactional coin, but no one's transacting. They're buying it and storing it, and so until it actually proves its worth. Now, I did have in 2012. I had a guy on the show and he talked about the $1 million pizza because the guy used Bitcoin to buy a pizza, and actually it's 2 pizzas. It must have been Little Caesars, but and that was $1 million worth of Bitcoin back in 12, and I think Bitcoin right then was around $1,000. It's $1 billion pizza now. It's crazy.
Exactly.
So it's just looking at anything in this world. It has to have a use. And it has to have a use to the general public, not just like if me and you use it, but nobody else uses it. It has to have a real big use to get the value it's basically claiming right now. I mean, even right now, it's around, as we tape this, around 60,000 a coin.
Yeah, we do need to be careful because it's not just the use today, but the potential use in the future. So there's always some option value that things could change. But you're right, there's got to be a use case.
Yes.
And that use case might be viable today, and it might be viable in the future.
Yeah. Well, fascinating. Folks, this is Professor Cam Harvey. When we come back, we're going to dive a little bit into precious metals and safe retirement strategies.